educational discussion purposes only. Nothing in this presentation is to be taken as investment advice or tax advice. This cannot be used to come back to us and say, we told you to do this and you lost money in the market, or you got tax penalties from the IRS. Nothing in this presentation is a recommendation to buy or sell any security or investment product. Please consult with us as your investment advisors or with your own investment advisors one-on-one before making any investment decision. In addition, we do not give tax or legal advice. Tax strategies based on this presentation are based on our own experience and are believed to be current, but please consult with your own tax advisor before making any decision. Investing involves risk, including the risk that you may lose some or all of your money. So, a little bit about us. This is my company, GFM Asset Management. We are a Hong Kong SFC licensed Type 9 asset management firm. There's our CE reference number. We are also a US SEC registered investment advisor. We span both sides of the Pacific. The US IRA investment accounts are managed by our US entity, that's a Delaware LLC. We manage investment accounts in liquid stocks, bonds, and currencies. So very often we're asked, how are we different? Our big difference is how direct we are. We don't use multiple layers of funds and vehicles and fees and so forth like that. We give straight answers and we invest client accounts directly into stocks and bonds. That provides also full flexibility to add or withdraw funds at any time with no penalties or lockups. And you speak directly with us, you get straight answers on any questions about stocks, maybe bond tax treatment, questions like that. We have a referral network of complementary services. Basically, we manage investment accounts. Now that does have tax consequences, and we don't do tax returns. We instead refer to preferred partners who do tax returns. Similarly, we are not a law firm, but if you do need legal advice, we have lawyers that we work with that do provide legal services. Also, we don't sell physical property, we don't sell gold, we don't sell art. These are other areas which we can refer other professionals that specialize in those areas as necessary. The founding partners of my firm, we each have over 15 years experience in global financial markets at top tier investment banks in New York, London, I would add Toronto, and now Hong Kong. So that's me and my firm. This is me personally, Tarek Dennison. I'm a certified financial planner, discretionary fund manager. These are a list of the banks that I've worked at. I have a master's in financial engineering from the University of California at Berkeley. I've also recently started lecturing on fixed income at ESSEC Business School in Singapore. You can probably guess I talk a lot, I write a lot, and I like going around and trying to educate the world on how to better use financial markets. I'm an avid follower of both Asian markets and US politics and tax policy. You will be pleased to know that since the December presentation, I've removed most, if not all, references to Mr. Donald J. Trump, which seemed to dominate the conversation last time I gave this presentation. So, a little bit of an outline. What is this presentation about? What are we going to talk about this evening? So first, right after I bring out the introduction, I'm going to have Chris talk about US taxes. Talk about which of you have to file US tax returns, how much you're probably paying, what are some of the ways to minimize or manage your US taxes, tax rates, the things involved there. And then we're going to get into the actual tools. So IRAs, and just generally, how do you do retirement planning? How do you do college planning? How does this fit into the overall picture of financial planning? I show some examples of what I call the $1 million difference. Basically, why bother with all this tax part anyway? What difference does it make, both this year, but more importantly in the long term? We look at the tax consequences of what I call IWA, not to be confused with DUI. This is investing while American. So IRAs and 401ks, you may be familiar with 401ks back in the US if you've worked in the US for a while and had an employer that offered it. Most employers here do not offer a 401k, and so we talk about what you can do instead. We do a brief comparison of traditional versus Roth IRAs. I also introduced the SEP IRA. How many of you here either have a SEP IRA or have heard of the SEP IRA? Okay, so this will be a good introduction to that as a possibility. I also am going to introduce 529s and other college savings plans, which you may or may not be familiar with. And I'm going to talk about the investing side, how to invest both inside and outside of tax-deferred savings accounts, how those things differ. So, I don't know why some of the other words aren't appearing here. This is supposed to be, okay, this is a checkerboard of the many different areas that fit into financial planning. So obviously there's the question of income, insurance, how do you structure it? Do you need trusts, living revocable trusts, charitable remainder trusts? Do you put wealth in companies or not? Let me just get all these up here. How do I fund education? How do I fund retirement? Do I keep my US passport? How do I give to the charities that I want to and get the most bang for the buck? How do I do estate planning? So these are all big questions that fit into the broad category of financial planning. And I do help with a lot of these areas. Some of them require a lawyer, some of them require an accountant, some of them require a company secretary. But one thing that does touch a lot of these areas is how money needs to be invested, and also how do you pay taxes on all the money that's involved here. So that's what we're going to roughly touch through here. What we're going to be focusing on today mostly though is education and retirement, because these are two areas where there are special tax advantaged accounts that Americans are eligible for. Now I'm going to hand over to Chris Chang, who's going to be talking about his firm and the taxes.
So I want to start off with a short story. I have a client named James, US citizen, living in Hong Kong for a couple of years. James earns about $150,000 of salary. He earns some interest income, $500 US. He had a small capital loss last year. He obviously qualified for the foreign earned income exclusion, and he came to me because he's actually getting his taxes done by another accountant in the US for the past years. So when I talked with him at the beginning of this year, he said, okay, I don't expect that I'm gonna have to pay a lot of taxes because I paid a lot of Hong Kong taxes last year. I said, okay, good. Kind of looked through his information, realized that he received his tax bill at the end of the year. Instead of making his payment on, so I looked through his records. Come to find out, he made his tax payment on January 4th, 2017. So what happened was James actually ended up paying about $7,000 of US taxes because he didn't get a benefit for taking the foreign tax credit, which could have helped him reduce probably about $4,000 or $5,000. So I think these are things that if he had made that Hong Kong tax payment about 5 days earlier. So these are kind of things that we need to plan for, help our clients ensure that they're maximizing the benefits and also ensuring that the returns are in compliance. So today what I talk about is US taxes and how we can help our clients. And these are just some of the general services that we help our clients with. So we focus on helping US citizens, green card holders, non-US citizens, helping them obviously with the US tax compliance, preparation, consultation. We help clients acting as power of attorney if needed or representation for IRS. Certain clients may need some estate and tax planning as well in assist with. So Tariq mentioned, introduced myself earlier. So my name is Christopher Chang. I'm a US CPA. I've been doing US taxes for just over 10 years. And through this time, I've been helping more than hundreds of clients getting taxes done, prepared, reviewed more than 1,000 tax returns. Our company is a Hong Kong-based company. We specialize in helping US individuals here in Hong Kong. A big majority of our clients are US citizens and green card holders. A lot of our clients are also non-US citizens who have US investments in, for example, US real estate or stocks and bonds that they need to file returns for annually. So we help them on an annual basis. Our company is listed on the US consulate websites, on asiaexpat.com, and also on a list of the Hong Kong, the IRAs list of tax return preparers. As we continue to build up our practice, we're specializing in helping more complex situations. And I want to introduce a couple of our strategic partners, Kurt Kalfuj and Victor Song. So Kurt is actually the prior director of taxation for the state of Hawaii, and he acts as the current chair of the Hawaii Council for Revenues. He is a CPA and lawyer and has a more than 30-year career in basically taxation and consultation services. Victor Song is actually acting as like a senior advisor, strategic partner for us as well. Victor has a long history working with the IRAs. He's worked with the IRAs for more than 30 years and was actually chief for one of the leading departments for IRAs. He was actually working in LA, and most recently he was senior VP for Samsung USA in the compliance department. So for today, what I want to talk about is just an overview of U.S. income taxes. I want to talk to you guys about FATCA or FBAR filing requirements. Then I want to talk about the foreign earned income exclusion and how that will help to benefit taxpayers. Then cover a little bit about a short case study. We want to kind of put things into perspective and explain some of the, actually go through one of the actual returns to see what the numbers look like for our situation, and just discuss some tips from taxpayer struggles and some other topics that we want. So I think one of the main questions that we always get, clients always are not sure, do we need to follow U.S. tax return? Probably the answer is yes. If U.S. citizens or green card holders make more than about $10,000 US on the roll, which is the standard deduction and personal exemption amount every year. So if an individual is working in Hong Kong, they're probably earning a salary of more than $10,000 and are required to file a U.S. return. They are also needed to, income often includes salaries, interest, dividends, capital gains, business income, or buying and selling property as well. Currently, income tax rates are up to 39.6%. It's the highest income tax rate. There might be an additional 3.8% as well for the net investment income tax. So for certain types of passive income, might have an additional 3.8%. Some states have zero income tax. For example, Texas is not income tax. Nevada and Florida.
Alaska.
Whereas some others have taxes at as high as 13.3%. Any guesses which state?
California.
So the same state that actually we had a famous saying, I love to pay my taxes. Same person said, I'll be back. Anybody? So Arnold Schwarzenegger, governor of California. So he was actually, California is one of the highest income taxes in the US. And he actually did say that famous quote. So in addition to the income tax reporting, there is FBAR, foreign bank account reporting. This is required for all U.S. citizens and green card holders. They're required to disclose the highest account balance of the foreign bank accounts, if the aggregate value exceeds $10,000 US. This is something that many people have told me before that they might have got mixed up with. They mentioned, hey Chris, I have some bank accounts, Standard Chartered account, $6,000, highest account balance. HSBC, $5,000. I said, oh, my accounts never exceeded $10,000 in a year, so I need to follow that. However, the requirement is if the aggregate value, the highest aggregate value exceeds more than 10,000. So you add up the 6,000 plus the 5,000, that's already 11,000, requiring the taxpayer to disclose all of the foreign accounts. So it's not just any account that exceeds 10,000, it's all of the foreign accounts.
Is this the one that we used to be due in June, now it's due in March?
So you're on it. So big news this year, the FBAR was due on June 30th, all previous years. However, 2017 is the first year the FBARs will be due on April 15th.
April 15th?
Yes.
Oh, not March.
April 15th, same as the US income tax
Oh,
return. However, it's also the first year they're allowing extension. It's the first year they're also allowing extension.
Allowing it, oh, there's extension.
So there can be an automatic extension that may need to get applied
Till June.
to October 15th. Automatic 6-month extension.
Automatic.
But
So it's not
you may
really
need to-
April, it's.
But you may need to still apply for the extension.
Oh,
So just like US individual income tax return, the normal deadline is April 15th for all US taxpayers. The deadline is April 15th.
that's automatic, so you
But
have to apply.
you need to, however, taxes need to be paid before April 15th
Right.
to prevent any additional interest from accruing. So that's kind of the key.
But you're saying it's fuzzy on the extension. percent.
So sometime, I'll need to, so usually the cases for US individual returns, that they require an extension and at least payments to be made, and then extends the deadline to the 25th date. In the case with the FBAR, I need to double check because this a bit just passed recently.
Okay, let's go to the website and look
Yes.
at it.
And with the FBAR, there's also the 8938 requirement. This has been, the FBAR requirement has been around for at least 20 or 30 years. With the FATCA, many people have heard about FATCA, but they're not really sure how does it affect me as an individual. This is the actual form. That's basically changing everything. This form, in addition, it's almost identical to the FBAR. However, there's a few more disclosure and a few more accounts that need to be reported. So in addition to foreign bank accounts, they also require foreign financial assets to be disclosed. Foreign financial assets could be, for example, some things like a club debenture in Hong Kong, maybe a debt instrument where someone may have loaned an individual money and they have a right to this money. So these are types of financial assets that may also need to be disclosed in addition to foreign bank accounts on the 8938.
And this is filed with your taxes.
This is filed,
Oh.
so Form 8938 is attached to
But the FBAR is not, it's separate.
But this FATCA Form 8930 is very similar to the FBAR. The requirement is for people living in the US, if the year-end balance is more than $50,000 US, they're required to disclose and report on the 8938. However, for people living overseas,
Oh, that's higher.
so they have an additional, basically the requirement is if the year-end balance exceeds $200,000 US at the end of the year, or $300,000 US at any one time, they may be required to disclose the Form 8938. It will be a bit higher if you're filing verifying jointly. This is one of the more common benefits that many people living and working overseas know about. The foreign earned income exclusion. In order to qualify for the exclusion, so the exclusion is $101,000 for 2016. It'll be $102,000 for 2017. What it allows taxpayers to do is exclude their foreign earned income if they meet some basic tests. They need to have obviously a tax home in foreign country and have foreign earned income. One of the common areas that people know about is the physical presence test. This states that you need to be outside the US for 334 days. The other one is a bona fide residence test. The physical presence test is a bit more liberal and easier to qualify for. Whereas the bona fide residence test might be more, there might be a bit more requirements in order to qualify. So in addition to the foreign earned income exclusion, Hong Kong is, based on the US laws, an expensive place to live. They also allow an exclusion of up to $114,000 on additional housing costs. So in addition to the $100,000.
Chris, so for the physical presence test, if you go to the US for business trips, does that count towards the days that you need to be outside?
So so this depends on if a person is considered a bona fide resident or not. In the first year, an individual probably will need to qualify for the physical presence test because they haven't established Hong Kong as a bona fide resident. So if they're only claiming the exclusion of the physical presence test, it doesn't matter if the trip is for personal or business. If they look at, you need to be outside the US for 334 days. But that part of your days in the US for work days would be treated as US source income, not eligible for the foreign income exclusion, which is the only issue there. So I always encourage our clients is to minimize the US work days if at all possible, because that also could potentially trigger state fines as well. So now just to cover a brief case study, talking about our friend James again. So the first person introduced at the beginning of the presentation. So James is an American filing a separate return. Basically, he has a Hong Kong wife, and after talking with them, they decided that it was in their best interest that they would not file a joint return. So they file separately, and they do not need to report his wife's income on his return. He's been living in Hong Kong since 2012. He earns $150,000 US, $500 of interest income, has a capital loss of $1,000 US. He pays $24,000 Hong Kong dollars a month for housing. Comes out to 288,000 Hong Kong dollars, and this is the average exchange rate for this year that we're using this year. And his housing cost is $37,000. He also paid $15,000 US in Hong Kong taxes. However, keep in mind that this is an area where there's a lot of room for flexibility and timing differences. So I think based on this situation, we estimated that based on 10% of his total wages would be his tax liability. Maybe in this year he paid less taxes, but maybe the following year he's going to pay more again.
Good question. Why is he filing separately instead of as head of household?
Because he doesn't have qualifying dependents.
Okay, so is the rule for qualified dependent, like let's say if they had a child and the child was a US citizen with Social Security number, that would make a difference.
So usually many people, okay, good question. So many people, head of household status is much more favorable than married filing separate filing status. Married filing joint is probably the best filing status for US tax purposes. However, for certain reasons, taxpayers may not want to file as married filing joint. So next, probably the best option is head of household filing status. In order to qualify, you need to have a qualifying dependent. Qualifying dependent is often a US citizen child. Is the most
Well, how about your wife?
For a foreign spouse, usually it doesn't qualify because it's a foreign spouse.
Oh, it has to be a
So it has to be
American.
it has to be an American with an
American,
SS
okay.
number to be a qualifying dependent.
So Chris, if he chose to file as head of household, assuming he has a child, does his wife's foreign spouse's foreign income become subject to US tax in that situation?
So usually not. In the cases not. Unless it's US source income potentially. But in most cases the answer is no. So what I want to do, so this is just the general information about James. Okay, this is, I'm not sure you guys can see that, but it's a bit small, and I have, maybe I can pass this around a bit later. This is some information. So what I've actually done is prepared James's tax return to see what his potential tax return might look like. Given his salary of $150,000, and based on these facts, he would be claiming a foreign earned income exclusion of about $115,000 US. This is the foreign earned income exclusion, $100,000 plus the additional housing cost.
Wasn't it more? Wasn't it
So housing cost was $37,000. However, it's limited. So the
Yeah.
US has a set amount, like a floor amount, that it needs to exceed this amount before it can be excluded.
Okay, so
The
how
floor
much
amount
was
is about-
excluded?
about-
34?
The floor amount is about,
No, how much did he, in that case, did he exclude?
he excluded about
34?
about $15,000 to $20,000.
Also, okay.
This comes out to in this case. So it's usually the excess of about $16,000.
Okay.
So in his case, he paid Hong Kong taxes, and this is what in my first story the taxpayer didn't do. The benefit is about $3,500 US. So this taxpayer is paying tax about $4,300 US. Effective rate is 18%, and his marginal rate is at 33%, which I think we'll talk about a bit later. But as married filing separately, you're putting the higher tax brackets much sooner.
Oh.
This is one of the unfortunate issues with filing separately. And I'm just gonna. Okay, I'm just gonna touch upon this very briefly. It's very important to stay organized with your tax records. Don't miss deadlines. April 15th, June 15th, and now there's 2 April 15th deadlines. And
So
October
say it again.
15th.
There's 2 April
So
15th.
that's
Oh,
what
yeah.
It's the income tax returns. And plan well. And so at least that once you plan, you know what kind of options you have to make better decisions going forward. So the more organized you are with your records, the easier it is to plan and make better decisions. Just very briefly, April 15th is the deadline to file income tax returns and also FBARs. June 30th is the automatic 2 month. So basically living overseas is the automatic 2 month extension. So tax returns are June 15th.
Automatic.
Yes. Then in the case that if you do need to file an extension it down is October 15th. And estimated tax payments are due quarterly if taxpayers need to make them. Due April, June, September, and January. So as living overseas and many foreign employers don't withhold taxes, you need to potentially pay estimated taxes throughout the year. And other topics we want to touch upon very, very briefly. So gift and estate taxes are something that can be very important at just understanding some of the topics there. Currently, the estate tax exclusion is about $5.4 million US. Gift taxes are excluded up to $14,000 per donee. It's a bit higher for spouses. So married filing donee is unlimited, but for foreign spouses, it amounts to about $140,000 US. Non-residents are usually not taxed in the US unless they have US sourcing. So meaning that non-US individuals. US real estate, potentially some people would invest in US real estate. These are taxed at potentially basically it's favorable tax benefits for depreciation, taking taxes on a net basis and taking deductions as well. So there's a lot of benefits there. And planning structures, this is just based on, people talk about LLCs, for trusts, like what are the benefits of these. This is an area where I don't want to talk much about it tonight just because it's so complicated. But this is an area where there's a lot of options for planning and for basically ensuring that taxpayers' goals and objectives are met. I think that I'll be handing it over to George. Right?
Unless you want to talk about the tax rates, that's a good handover topic.
Okay, I think that we can talk about it. So in our situation, we talked about our friend James. James was in the, okay, so as an individual who was married filing separately. Okay, so James has been married filing separately. His income was between $150,000 and $200,000. As such, he's put in the 33% tax bracket. Whereas you can see the same individual who is filing single would have been put in a 28% tax bracket. So that's kind of how understanding these intricacies can really affect the taxpayers' situations and how their basically what their marginal rates are. Marginal rate is just that what will the tax rate be in the next dollar earned.
And as you can see, the tax rates also differ by what type of income we're talking about here. So ordinary income tax rate, this is the tax rate that you pay on salaries, interest income, gains on foreign currencies, and so forth. Much of the tax that I'm going to be talking about deferring is going to be on other investments. So this is, for example, going to be capital gains on stocks that you sell. There are two other categories that you may be interested in: collectibles and certain small business stock. You may know this if any of you invest in, say, gold, silver, or art. The tax rates on those are as high as 28%, whereas they tend to be 15 to 20% for selling stocks and bonds. And then you may or may not ever have to worry about unrecaptured Section 1250 gains. This again is something that tax geeks who know forms by name and number care about. This is if you take depreciation on certain types of real estate and you recapture it later, you're going to pay a different tax rate on it than any of these other two. But getting on to how we head off from the tax presentation, the investing presentation, I know my friend Christopher Chang is a big fan of Albert Einstein quotes, and he very often begins his presentations with this quote: "The hardest thing in the world to understand is the income tax," and I complement it by bringing up another Albert Einstein quote, which is, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't understand it pays it." It may sound a little bit funny, but it's actually very, very powerful and very important. Earlier on, I promised to describe what I call the $1 million difference. Again, this is the question of why bother deferring taxes. Okay, we talked about a few $1,000s here and there. Maybe if I make the IRA contribution, I'll save a few $1,000s in taxes this year. If I put it into the Roth, I actually don't save any taxes this year. So why should I bother deferring taxes? So here we have a simple case where I want to say, even with the relatively low $5,500 US a year that we're allowed to put into our IRA accounts, So this is much lower than what you could put into a 401k or a SEP IRA. I just want to say over the course of a working career, if you do this every year for 40 years, that's $220,000. If you invest that with an annualized rate of return of 10% per year, the difference between deferring taxes and not deferring taxes is whether that account ends up being worth $2.7 million or $1.2 million. So that's the difference in taxes, and we're not talking about an over 50% tax rate. The assumption that we've made here is, I was assuming a 30% tax rate. Yes, tax at 30%. So what I'm assuming here, we've got two bars. The blue bars are what happens to the account if you put away the $5,500 every year. It earns 10%, and that 10% gets to compound year after year after year after year. That's how we said that at the end of 40 years, that account would be worth $2.7 million. If, on the other hand, you kept the money out in a taxable account, let's say, for example, you bought stocks and bonds in them and you didn't even hold them long term, you were trading them frequently, or you bought a actively managed mutual fund. All of those gains every single year would be taxed at that marginal rate we looked at earlier, which could be 33% or 25% or whatever your rate may be. Here I'm just assuming that it's 30% to keep the numbers round. So you'll notice that every single year your account can't grow quite as quickly. In fact, it grows at around 7% per year compounded rather than 10% per year compounded. Again, that may not look like so much in any one year, but that difference is what compounds over time. And this is what I call the $1 million difference in only the $5,500 per year contribution. Now later on, when we look at 401ks and SEP IRAs, where the amounts are much, much larger, you can multiply each of these accordingly and see how important it is to save taxes and defer taxes every year if you can. So just to give it the example here, I gave some brackets of numbers. You could have started this when you were 19 or at 25 or at 30 and a half. The significance of each of these we'll see when we looked at IRA accounts. So so far we've mostly been talking about US tax. We just want to quickly contrast how does US tax compare with Hong Kong tax. So as you may know, Hong Kong tax is source or territory based. If you've ever filed your tax return here either for your company or for your individual, Hong Kong doesn't care about income that you earned in the US. They don't care about income that you earned in mainland China or in Japan or anywhere else. They care about income that you earn in Hong Kong, and they tax it in Hong Kong. The rates here are around 15%. 15% personal, 16.5% for companies, and that's a flat rate. They don't have a big complicated set of brackets like we had earlier. There's no capital gains tax in Hong Kong. You buy or sell stocks, you can day trade them, you can hold them long term, there's no capital gains tax. Hong Kong does not have a tax on dividends and interest. There's no estate tax. So if you die here a multi-billionaire, the Hong Kong government doesn't take any of it just because you die here. The one big disadvantage of being a purely Hong Kong person and not being a US person from a tax point of view is if you're a Hong Kong person and you buy a US stock, the US government will withhold 30% of the dividends in taxes on dividends sent to Hong Kong. Now me as an American, I don't have this withholding because I give my social security number, I file my W-2 and my W-4, W-9, W-8, W-9. And they got it, they don't withhold the taxes, and I file the tax on the dividends on my tax return. Now contrast this with US taxes. US tax is citizen-based. If you look on the inside of your passport, you will notice it has a reminder in there that you have an obligation to pay tax on your worldwide income because you're a US citizen. It doesn't matter where that income came from, it's citizenship-based rather than source-based. US rates are typically between 25 and 35%. Can be a little lower, can be a little bit higher. The US does have a capital gains tax. The US does have taxes on dividends and on interest. And there is an estate tax. If you die with a net worth of more than 5.45 million US dollars, you can pay, up to 45% of that to the US government as an estate tax. And the difference in the US tax here is that we don't have the 30% withholding tax with the US, but we may be paying 25 to 35% on those dividends depending on whether they're qualified or not, depending on what our bracket rate is. One thing, if any of you in this room are not US citizens and you are a client of mine and I buy US stocks for you, you'll notice this is why I buy US stocks using derivatives for non-US taxpayers whereas I'll buy them directly for US taxpayers. It's for that tax reason. So, now let's talk about IRAs. Does anybody here not know what an IRA is? Okay, so just as a bit of a review, IRA can stand for Individual Retirement Account, or it can stand for Individual Retirement Arrangement. Basically, it's just a section in the tax code for a certain type of account that you can open that lets you defer taxes in some way. We're going to talk about a few different accounts where one, you get to put money in and then use that to reduce your taxable income this year. There's another kind of IRA where you get to put the money in, you don't get to reduce your taxes this year, but then you take the money out tax-free, gains and all. But that's the whole idea. It's just a different account that you can open to save money for retirement and pay less tax than if you didn't put it in the IRA.
Which one is more beneficial, or is it?
I'll discuss those later.
Okay.
So here the differences that we're going to talk about is the difference between investing in an IRA while you're abroad versus having an IRA or a 401k when you're back in the US. And also, so I know, how many of you in here have a 401k from back in the US when you've worked in the US at some time? Okay, so you're familiar with what the 401k is. 401k is similar to an IRA, except that it's set up by your employer. And when your employer in the US pays you for your job, they'll say, okay, we can take out about 15% of it, and we'll put it aside in an account for you for your retirement, and you won't have to pay tax on that. You'll get very similar tax advantages to what you'd have in an IRA. So what's the difference? So one of the big differences is that if you live in the US, your employer is probably already going to present you with a 401k form, just like here you get an MPF form saying, do you want to sign up or not? You're going to get reminders from Charles Schwab and Fidelity every week on the radio, have you made your IRA contribution or not, and so forth like that. One of the things I've found in Hong Kong, and one of my main missions for the next 6 weeks before April 15th, is to make sure that no American neglects to make their IRA contributions, because many of them are not reminded, and many Americans here do neglect their IRA contributions. So my first recommendation is, even when you're abroad, do it if you have the qualified, non-excluded income. If you're sending any tax money back to the US, you should contribute to your IRA. One of the reasons also is that very few expats can contribute to 401k. Very few companies here set up 401ks for employees working in Hong Kong. Your MPFs and your ORSOs don't count. They're not generally US qualified, and you probably noticed money that you put away in your MPF and ORSO, Hong Kong doesn't tax it, but it's still considered taxable income from US tax purposes. So you won't have to pay any state taxes, and you're not going to be saving US state taxes, but Hong Kong is not going to give you any break for money that you put in an IRA. So this may seem a little bit complicated because you have your MPF and your ORSO. This is money that Hong Kong's not taxing, but the US is taxing. And then you have this money that I'm telling you to put into an IRA. The US is going to not tax it, but then Hong Kong will still tax it. Trust me, one of the things I'm working on, I am trying to set up a US qualified NPF or ORSO plan somewhere here in Hong Kong. It has been a lot more expensive and a lot more difficult than I've expected. So if any of you know some very, very nice trustees who do this, I would love to talk to them. Also, one other difference between doing it in the US versus doing it here is that your employer may be flexible in allowing you to do a SEP IRA instead of having a 401k. I'm going to explain later what the difference of a SEP IRA is. If you thought that the $5,500 a year wasn't really enough to bother with, a SEP IRA will let you put away about $52,000 a year, and that could save you, what, maybe $15,000, $20,000 a year in US taxes, if that's about how much you're sending home. So, if you still have an IRA or 401k back in the US, I often recommend that those get consolidated and rolled over into IRAs so that they're not forgotten, they're not neglected, they're all in one place, you know how they're invested, you know how they're taken care of, you know you have access to the money. I heard a study from the Wall Street Journal earlier talking about the large percentage of 401ks, even of Americans back in the US, that they've still left with their old employers, that they've forgotten about, they've neglected, they haven't rebalanced, and then 5 jobs later, they need to go back to all of them if they actually want to get their money back when they retire. So if you have the opportunity, by all means, roll your 401ks over into a single IRA account that you can monitor, manage, and watch closely. So one benefit, one upside that you probably should look at is that if you do not have a 401k, if you do not have another qualifying retirement plan, Your IRA may now be deductible. While you're working in the US, if your company offered you a 401k, even if you didn't use it, but if your company offered you a 401k, you could not deduct your IRA contributions if you made more than some minimal amount of money. That was just IRS rules, I didn't make it up. If you made more than 100 something thousand, I forget what the number is, you also were ineligible to contribute to a Roth IRA. So you were kind of stuck. You could contribute to a non-deductible IRA and do a backdoor Roth IRA. There were a few other ways around it, but it was kind of tough. Weird upside here now, you don't have a 401k. You now know for sure that no matter how much money you can make it a contribution to an IRA, and you can deduct that from your US taxes. One other thing that you probably notice is very true about any of your friends who have IRAs back in the US. You'll notice that even more than US accounts, IRAs are terribly under-diversified. They are overwhelmingly invested in the US. They are invested in US stocks and US bonds. Very few of them have invested in Asia, in Europe, in foreign countries. Many of you who've lived and worked here in Hong Kong, you probably have an idea of what relative value there is in buying some Chinese equities, Hong Kong equities, Australian stocks, and having a more diversified portfolio. So that's one thing I'm trying to help correct as well, is to make sure that IRAs are properly invested and properly diversified. Back in the US, you have state tax considerations, which you probably don't have to worry about here, unless Chris tells you otherwise. So now I'm going to talk about, you were mentioning the difference between a traditional IRA and a Roth IRA. These are the two types of IRAs I mentioned earlier. So in a traditional IRA, the money that you put into the IRA now is tax deductible. So just to make up some numbers here, if you make $205,500 US, and you contribute $5,500 to an IRA, that reduces your taxable income, and you're now taxed as though you only made $200,000 US. If you figure out what your tax bracket is, and assuming you're in the 39.6% tax bracket, 39.6% of 6,500, now this assumes that you're age 50 or over, can be a tax savings of up to 2,574 US. So if you need any kind of tangible reason of why you should contribute to your IRA now, this is why you should do it. One thing to keep in mind about traditional IRAs is that your withdrawals are taxable. So you're saving tax now, but when you take the money out, you have to pay tax on it. Now I do get asked about this a lot. There's always the worry, tax rates are going to be higher in the future than they are now. If the deficits are now, they're never going to be, I'm going to pay more tax later. You really have to look seriously about what your relative tax rate is. If right now you're in really peak high earning years, if you're earning several $100,000 a year and you're in a very high tax bracket, and you're expecting that when you retire, you're really going to downgrade to a simple life, you're going to withdraw the minimums from this account, and maybe you'll have some other tax exempt income, you may actually be in a lower tax bracket when you retire. You may get to use those exemptions every single year that right now you're not getting to take advantage of. So those are things to weigh, those are things to look at as part of an overall tax plan. Traditional IRAs can be converted to Roth IRAs. And this is something that we often recommend that you do if you see a dip in your income. If, let's say, for example, you have a year where you're on a sabbatical, maybe you've left your job and you're going to start a company, that's a great time to do a Roth conversion. Basically what happens is you take the money from the IRA, you put it into the Roth, you pay the tax on it once, and then you'll be able to take it out from there tax-free, which we'll talk about later. So, in summary, the traditional IRA is better if you have a high income now, and you expect that your tax bracket in the future is going to be lower. You expect you're going to be in a lower tax bracket in the future. One thing to keep in mind, if you have money in a traditional IRA, from your 70th and a half birthday, I don't know why it's 70 and a half, but from the time you turn 70 and a half, you have to begin taking mandatory minimum withdrawals. The reason is because the IRS has let you put off taxes all that time. They eventually want to get paid. And they set the rule is from your 70 and a half birthday. How many of you celebrate your half birthdays, by the way? Okay. So I want to contrast that with the Roth IRA. The Roth IRA, you do not get a tax deduction now. So you take $5,500 and you put it in the Roth IRA, your taxable income remains the same. But the big difference is that once you put the money in there, all the gains, that $5,500 that you put in there year and year after, becomes $2.7 million, you get to take out $2.7 million tax-free. That's the big difference.
Can you do both in the same year?
I don't think so, actually. Can you do both in the same year? I think you have to choose one or the other, right? No?
For many people living overseas, so I think that, so I guess it really depends on what the options are. But usually there's contribution limits. So based on contribution limits.
So I guess what you're saying is you could contribute $2,500 to one, $3,000 to the other, but
But I think that you probably have to structure it right. So if you can qualify for the Roth, that might be an option. But qualifying for a Roth contribution to democracy is not as simple as traditional for many taxpayers. I think that that's one case. Actually, I'm not. To be honest, I'm not certain about that answer. I've never had a question come up before.
I understood, and again, I'm not a tax professional, I understood that the contribution limit applied to all types of IRAs you contribute. So you have 5,500, and you can contribute that amount in any combination of IRAs you have, but it's not like you can do 5,500 and this one. Yeah, exactly. One thing to keep in mind, you can convert a traditional to a Roth, you cannot convert a Roth back. Because imagine what that would mean. It would mean you're getting money back from the government. They don't want to give you money. So Roth IRAs are generally better if you are younger and you expect to be in a higher tax bracket in the future. So one reason is if you're starting this plan early and you know that by the time you're 70 and a half, you're going to have millions of dollars in a traditional IRA, and you're going to have to take those mandatory minimum withdrawals, and that's going to force you into a high tax bracket. That would be a good reason to try to keep more money in a Roth so that you don't have that problem. Roth IRAs do not have mandatory minimum withdrawals. They're never going to force you to take the money out. In fact, if and when you pass away, then those get inherited. Those are treated differently for that reason.
There is an income limit for Roth IRA, right? Like you earn over a certain amount.
Yes, that's exactly. So that's why what we're saying is for the traditional IRA, if you don't have a 401k plan, you definitely get the tax deduction here. But many people earn too much to contribute to a Roth. But that's where you heard I mentioned earlier the backdoor Roth IRA. Backdoor Roth IRA, basically you do a traditional IRA and then you do a conversion.
But then you lose the tax deduction benefits, right? You have to pay back the tax.
You have to pay back the taxes. So the nice thing about conversion is you get to time when you do it. Like let's say for example you're in a business where you're getting lots of bonuses and you have a bad year and you say, okay, I'm going to lower tax bracket this year. Now I want to do a conversion. So you get some choice on when you do it. So just a reminder, consider a Roth conversion whenever you expect that you're in a relatively low tax bracket. So now I want to talk about a difference between individual IRAs and SEP or simple IRAs. So everything we've talked about so far are the individual IRAs, $5,500 per year if you're under 50, $6,500 per year if you're 50 and older. That's not a lot of money if you start young and you keep it up and you invest that well. It's enough for a good retirement, but you notice 401k plans this year are allowed to put in $18,000 a year, which is it's over 3 times as much. And this always struck me as a little bit unfair. Why should you be able to contribute more if your employer sets up one of these plans than if you just do it on your own? But the answer to that is a SEP IRA or a simple IRA. I'm going to talk more about SEPs than simples, and you'll see why in a moment. So one thing about an individual IRA is it's 100% individual. It's entirely up to you. You can go and you can open one tomorrow. No one's going to stop you. No one else is going to ask you any other questions other than what you need to open the account. But the limits are relatively low. They're $5,500 a year or $6,500 if you're 50 and over. You can do a Roth or a traditional individual IRA. And you have to make your contributions by April 15th of the following year. So for the next 6 weeks, I'm going to make sure every eligible American has made their contribution for the 2016 tax year. You can make it before you file on April 15. If it's the deductible IRA, you get to deduct it off your 2016 income. I often say this is also a good time if you're falling a little bit behind, because you can make your 2016 and your 2017 at the same time and get it over with. I also often recommend doing it as an auto pay so that you just don't forget. It's just coming out and it's there and it's going. But you do have until April 15th to make your contributions for the previous tax year.
So many people might actually wait until April 15th to make that payment as well. So when they have that money, they still get benefit from 2016 tax year.
But you don't get an extension for it. You have to make
before the April. That's right.
Yeah,
It's very
it's-
strict about making it before that deadline.
you've got to make it by the April 15th deadline. So the difference is the SEP IRA. So SEP stands for Simplified Employee Pension. The way of thinking about this is it's basically a 401k, but for employers who don't want to bother with all the hassle of setting up a 401k plan. There's actually just a simple form to fill out, and they just put money into an account like an IRA. It has much higher limits, which have an advantage. There's another plan called a SIMPLE. SIMPLE stands for Savings Incentive Matching Plan for Employees. I don't talk about SIMPLEs very much because they're a lot more complicated than SEPs and in individual IRAs. Their limits are lower than SEPs, but they're higher than individuals, and there's just more paperwork involved for the employer to manage it. But the difference in this column is these are IRAs that are contributed by the employer. Now you're asking why may I be talking about this? If your employer here will cooperate, if they'll say, okay, fine, I'll fill out this form, and then I trust that you're going to take that money and that you're going to put it into the IRA account according to this formula, that can usually work in Hong Kong. In the US, that's a little trickier because if they have a federal employee ID number and they actually need to submit these filings, the IRS may match these where they're not going to do it with a foreign employer. So that's another advantage that you have being over here. But do know that SEP IRAs are technically contributions that come from an employer. The limits are much higher. So for a SEP IRA, you can contribute up to $53,000 US in 2016. So take that against whatever your tax bracket is. If you're making $300,000 US a year and you get to knock off the highest tax bracket, that's a pretty significant tax savings. One thing to keep in mind is there's no Roth option. SEP IRAs are always traditional, but if you're making that much money, you probably would want that tax savings up front anyway. There are also a few other requirements so that employers may have to show that they're treating all the employees equally. One of the reasons that Simples are more popular in the US is that, let's say for example, I'm a small company and I've got some really high paid directors and I have a few salespeople, a few administrative staff. I may not want to contribute the same percentage to each of their pensions that the SEP may require. The Simple can also require the employee to contribute a bit, whereas the SEP is technically supposed to be all money from the employer. Another nice thing about the SEP IRA is that you do get extensions. So this money can be put in as far as the employer extends their filing deadline, which can be in October of the following year. So one thing to keep in mind, neither of you will shelter your income from Hong Kong taxes, but you still do get the foreign tax credit for any Hong Kong taxes that you pay. So I wanted to have a quick chart here showing what a difference having 2% or 4% more or less per year will make after retirement. So here I've assumed the earlier example where you're contributing $5,500 per year and then you've gotten that $2.7 million retirement account we talked about. So here you are at retirement. One of three things can happen. We want to assume that in the blue case, you withdraw at a rate of whatever your rate of return on investments is, less 2%. So let's say you switch to more conservative investments, you're now earning 6% per year on your investments, and you're withdrawing at a rate of 4%. So on $2.7 million, you're taking out about $100,000 a year, but you're still letting some more money go in there and grow. That's the plan where your account gets to continue growing even in retirement. Contrast that whereas if you withdraw your whole return, now I'm not talking about what exactly is your rate of return. If you make 6% and you take out 6%, or if you make 4% and you take out 4%, that'll just make sure that your account value stays the same. You spend interest and you preserve principal. And there's a third plan where you withdraw $100,000 a year and you have a low 2.25% rate of return. So you just buy 30-year government bonds and take no risk. Well, you'll still have enough money, but it'll run out probably around the time that you turn 100. So these are three different financial plans for 7:30. Okay, sorry, we'll quickly zip through this and so we have a few minutes for Q&A. I just want to quickly talk about what's the difference between how you invest your taxable account versus how you invest the IRAs. I have slices of a pie here. Very often I say in your taxable accounts, that's where you want to put your high beta, your technology stocks. The reason is if they lose money, you you get to harvest tax losses. Also, when they have gains, you get to take advantage of long-term capital gains. Also, any tax-exempt muni bonds should be bought in taxable accounts, not in IRA accounts. Your real estate, this is your physical real estate that you can depreciate and have interest deductions, should be bought in taxable accounts, as well as any MLPs and partnerships. If you get a Form K-1, you don't want that going into your IRA account. You'd rather do that in your taxable account. Now, by contrast, IRAs, you'll notice we have stocks on both sides. I typically recommend putting blue chip stocks in IRAs because you don't get to write off losses, but then your dividends all go in there and they compound tax-free. Any currency trades, any currency strategies, futures should be done in IRAs, as well as any taxable bonds and REITs, real estate investment trusts. Not to mention any gold or collectibles that would otherwise be taxed at 28%. This is all the stuff about college planning. Sorry, I'll have to zip through it, but I can send you the slides if you're interested. This is annual index of the cost of college compared with other prices. This is why the cost of college has gone up. This is my economic explanation. Short answer is people have been borrowing more. Tax loss harvesting. If you cannot contribute to IRAs for whatever reason, this is another way of deferring taxes fully within taxable accounts, something that anybody can do. Short answer is hold on to all of your stocks, hold on to your winners, sell the losers, claim your tax loss credits, and then keep rolling the position and repeating. I have the table here which explains how it works. I'm happy meeting you one-on-one to talk about it as well. So taxes aside, what are the most important things to do? Number one, have a plan. Number two, ensure that all your actions and allocations match that plan. Some of the most common mistakes I see are not having a plan. Waiting too long to make contributions. So that one of the reasons I had that slide there is, oh, you know, I'm young, I need to live my life. If I just wait another 10 years, I'll start saving then. That's a very, very expensive mistake. Also, not contributing regularly or not paying attention to where your contributions are going or how they're being invested. Investing too conservatively. Earlier today, I met a client who was under the age of 50 and was 60% in cash. And I was telling him he was not going to make his retirement goals if he stayed that way. Also, part of this is not diversifying out of one's home country. The mistake here in Hong Kong is everybody is too much in Greater China. Americans invest too much in the US. Australians invest way too much in Australia, even though they're a tiny little country down there. The other mistake is investing too aggressively. Many of my colleagues in Silicon Valley lost a good chunk of their IRAs, having all of it in technology stocks in the year 2000. Chasing trends, not diversifying, those are all fairly common mistakes. Another is paying too much in fees, not paying attention to what you pay. So just as a history of will tax rates go up or down, here's a history of what tax rates have been since we had an income tax in the United States. This is a chart of our debt as a percentage of GDP, and this is our contact information. I think you had your business cards up here. My business cards are up here as well. I think we might have a few moments for questions, or we can talk around the pastries and beverages up there.
Ask people if you want to just fill out evaluations form.
And please fill out an evaluation form here.
To help out, so we have a contact and it can be perfect as well.
Exactly.